Good morning, everyone.
Good morning, sir.
Good morning. Good morning. So today, as consolidation is done, the major five standards are done. Today, we'll do share-based payment and the small standards. And before the exam, please revise sustainability, IFRS S1, S2, and few important points which we have done in the class. We have done 4 to 5 questions regarding your sustainability also and revise ethics. So with that, the major part already we have done each and everything. So chalo, then let us start with IFRS 2 today. Share-based payment. Revision of your share-based payment. It's a very important standard from SBR point of view. There are 4 types of questions that usually come from share-based payment, and we'll cover each and everything. Chalo. IFRS 2 share-based payment. Then sir, this share-based payment will include what also? Equity settled share-based payment, cash settled share-based payment, share-based payment with cash alternative, share-based payment to other parties, not employees. Yes, sir. Now, this share-based payment, you have ESOP, sir. ESOP accounting we have done. Now, in consolidation, better. In consolidation, we have share exchange. In consolidation, we have share exchange. Is that covered here? Huh? It is not covered here. It is covered in your IFRS 3 only. In your this one. Consolidation. So now let us jump into the share-based payment part. Equity settled share-based payment. Equity settled share-based payment. In exam, how will you identify whether it's a equity settled share-based payment? Share options will be written or ESOP will be written. For cash settled share-based payment, it will be written SAR. And for cash settled share-based payment with cash alternative, it is a hybrid instrument. Very rare chances. The chances are high for these two. Share based payment done to any party when we purchase any goods or service, and cash settled share based payment, because here the value will change each year. You have to keep that in mind here. Yes, sir. So see here now. Chalo, let us start. We have taken an example of this in the class. Will not come to that now. Now remember everyone, basic point, basic point. So share based payment expense is recognized over the period or not? If the company is giving you ESOP after 3 years, will the company recognize the expense after 3 years? No, sir. The company will recognize the expense over the period. So, share-based payment is what? Share-based payment is an agreement between reporting entity and other party, including employees, in which the entity will receive goods or services. If the settlement is done in what, sir? Shares. If I say I will give you shares, it will be equity settled. If I say that I will give you cash, I will give you cash, but this cash is based on the share price. Issue shares equity settle. If this is based on what, sir? If it is based on the share price, then in that case it will become what? Sir, in that case it will become your this one. What we say, cash settle share based payment. Simple, sir. Then IFRS 2 will not apply to what also? Financial assets, issue of share under business combination, and issue of shares to what, when we issue share capital, when we issue new shares to the shareholders, it will not apply. So we have taken a basic example. What are the basic examples, sir? That if 100 ESOPs are given over 3 years, yes sir, 100 ESOPs, 100 employees are there, 100 employees, and for each employee 100 shares are given and the value is 10. So what is the expense? 1 lakh. This 1 lakh expense we recognize over the period. 1, 2, 3, that is 33,333. We record this as an expense, and we accumulate this in what? We accumulate this in equity, because the shares are not given today. This will be a reserve. This will be what, sir? Equity reserve. Equity reserve. Yes, sir. Now, okay, chalo. Now coming to some basic points which you have to understand. Sir, basic point. Here, this is a timeline which we have to understand. Sir, what is the grant date? Grant date is the date on which the share-based payment plan is announced to the public, not to the public, to the employees. Yes, sir. Then vesting condition. What is vesting condition? Condition to be satisfied by the employees to be eligible for the share-based payment. So they have to work for 3 years, then only they will be getting the share. So vesting condition is what? They have to work for 3 years. Vesting period is what, sir? 3 years. Then we have vesting date. Vesting date means what? Date on which the conditions are being fulfilled, and after this date, the employees can exercise. After this date, on this date the employees will become eligible to take the shares. Yes, sir. Once they become eligible, the company will give a time period for them, that you have 1 year or 2 years to exercise these shares. Yes, sir. And then this is the last date when the employees can come and collect the shares or take the shares. Yes, sir. So vesting period from the grant date to vesting date. Yes, sir. Yes, sir. Then exercise period is what? Period during which an employee can exercise the share-based payment plan. What does exercise price? Exercise price का meaning क्या है? Exercise price means price at which an employee can purchase the shares. Today the value is 100, but if you exercise these shares, you have to pay 20 rupees. So this 20 is known as what? Exercise price, sir. 20 is known as exercise price. Sir, can the exercise price be zero? Yes, the exercise price can be zero. Simple. Yes, sir. Now coming to the first type of this one, equity settled share based payment. So in equity settled share based payment, what will happen? In equity settled share based payment, shares are given, and how will you identify in the exam? Share option or ESOP. Your ESOP is recorded over the vesting period on SLM basis. Employee benefit expense is calculated based on the fair value of the option announced at the grant date. You have to mention this. Fair value is considered on the grant date. Any change in the fair value after that date will not be considered. It will be ignored. Yes, sir. So what is the fair value of the option? It will be given better. No need to rectify this one. Sir, if the fair value of the option is not determined, if it is not given, then use intrinsic value. This also will be provided. 100 percentage fair value of the option will be given at the grant date. Take it and record this as an expense. Yes, sir. So see here now, what is the formula, sir? The formula, the calculation of expense for each year. Number of employees expected to fulfill the condition at each balance sheet date into the number of options per employee into fair value of the option at the grant date into vesting period divided by total vesting period. Yes, sir. Less what? Expenses already recognized in previous year. What we say, less expenses which has been recognized in previous year. We get the expense that should be recognized in the current year. Sir, how do we calculate this, sir? What is the calculation? See, total number of employees, the number of employees in the company minus employees actually left till that date. In the first year, how many employees left till that date? Then employees expected to leave. How many employees will leave in future? We do this and we get the value. Then on initial date, on the grant date, will there be any journal entry? Nahi Baba, no journal entry. Yes, sir. Then vesting period. During vesting period, what do we recognize? Debit employee benefit expense. Each year we recognize what? Debit employee benefit expense, credit what? Equity. Credit what? Equity. So this employee benefit expense will be recognized in P&L under operating category as an expense. Under equity, we accumulate this because in future we will issue the shares. Yes, sir. We will issue the shares. Yes, sir. Sir, whenever there is a decrease in expense, the estimate which we have done is not correct. There is a estimate reversal. So what will I do? I will debit equity and credit P&L reverse. In one or two questions, we have seen reversal part also in your exam kit. Questions are there. Now this was a basic question. Question lete. I will take one question. Do not worry in that. Okay. Let me take this question only. Let me explain it. Yes, sir. So equity settled share-based payments. An entity has a reporting date of 31st December. On 1st January 2000 it grants 100 options to each of its 500 employees. Okay, it grants what? 100 options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2000 They have to work for X1, X2, X3, 3 years. At the grant date, the fair value of the share option was $15. Yes, sir. 2000 X1, 20 employees leave, and entity estimate that a total of 20 percentage of 500 employees will leave. So 20 percentage of the 500 employees will leave. In total, they are saying already 20 left. So can I say this 20 left is already included in this 20 percentage? Yes, sir. So what will I say then? In 2000 X2, a further 20 employees leaves, and the estimate is only 15% of the original 500 employees will leave. So how many are remaining here? Here 80 percentage are remaining. Here 85 percentage are remaining. Yes, sir. So Sienna. Then 2003, a further 10 employees leave the company. So what is my vesting period? 3 years. Fair value is 15. Employee 500. Share option 100. So what will I say? See, Sienna. 20 left. 80 will be leaving. So what is the total? So total is 100. 20 left. The total is what? Yeah, 75. Then at the end we do this calculation. So see here, what is my calculation? So 400 employees are remaining. 425 and 450. So the expense which we have to record is based on 400, 425 and 450. So what will I write the first one? As per IFRS to share-based payment, equity settled share-based payment will be recognized as an expense over the vesting period. The expense is recognized based on the fair value of the option at the granted technical marks done. Then every year you have to explain the expense. Sir, the entity should estimate the number of options to be vested by the predicting the how many employees will remain till the vesting date. It believes that 80% of the employees will stay for 3 years. So 500 into 80 percentage into 100 into 15 into 1 by 3. That is 2 lakhs. So for the year ended first year and the expense will be what's a 2 lakh and the corresponding credit will be there in the equity or increase in equity. Year 2, what will happen, sir? Year 2, what is the data? Sir, 425 employees are there. How many employees? 425. So what will I take? I will take 425 425 into 100 into 15 into 2 by 3, $425,000 minus $200,000 which you have already recognized. So the current year income, the next year expense is what? So the next year expense is $225,000 and a credit in equity also we increase the equity. Then third year what we say? So third year actually 50 employees leave the company. Why? 20 left in first year, 20 in second year, third year 10. So they leave it. We recognize 675,000 less expense recognized in previous year, that is 425. So the current year expense will be what? 25,000, $250,000, and it is an increase in equity, sir. So with this, your basic part of what, sir? Basic part of your equity settled share based payment is done. Yes, sir. So with this, the first type of question is done. Now coming to the conditions, which you have to understand a little bit in detail. Conditions, sir. What are the conditions? Vesting condition, non-vesting condition. Vesting condition and your non-vesting condition. So vesting condition means what? There are two types of conditions: service condition and performance condition. Service condition, we know, sir, that you have to work for these many years, then only you will be getting the shares. So we have seen that expense is recognized over that vesting period. Simple. Sir, in performance condition, there are two types: non-market and market condition. Sir, non-market and market condition, what we have to remember, one important thing. Sir, in non-market condition, what are the example for non-market condition like sales target, profit target, earning, increase in EPS? So expense will be recognized over the estimated vesting period. Sir, can we revise the vesting period here? Yes, we can revise it. No issues in that. In non-market condition, we can revise the vesting period. Sir, in market condition, to achieve the share price target, etc., increase in share price, expense will be recognized over the vesting period. Vesting period needs to be assessed on the grant date and no further reassessment or no further remeasurement will be done or reassessment will be done. So once we have mentioned today ki, okay, it will take 3 years to reach the share price for $400. After that, we will not change it. We will recognize the expense on the basis of 3 years. Sir, before 3 years only, the share price hits a target of 400. We can recognize the entire expense in second year only. So see here now, I've explained in the class also. Non-market condition means, sir, non-market condition means what? We have an estimate that it will take 4 years. But sir, after the second year, we get to know it is taking 6 years. Then what we will say? Sir, at the end of the second year, we estimate that it will take 6 years. Instead of 1 divided by 4, we will take now 2 divided by 6. We are changing our estimate. Yes, sir. But sir, when coming to, okay, this was an example. This was an example which we had done. So no issues. Then when coming to market condition. Sir, in market condition, can we change? Can we reassess the value every year? No, better. Reassessment possible nahi hai. It is not accurate. It's not good to do that. Simple. Why? In the class we have discussed what is the reason, etc. XYZ. See now, market condition. Share price should reach to $10. So today we estimated 4 years. Yes, sir. So for 4 years we recognize the expense. Now see, we decided 4 years. Yes, sir. So at this 1 by 4, and then at this, what will I say? Will I do it 2 by 6? No, 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 no. Here we say ki sir, it will take total 6 years to reach the share price. Can I change it? Nahi, Baba. I can't change it. Simple. Yes, sir. So market condition, this is an important sentence which you have to write down for technical marks. What is the standard saying? If market conditions are satisfied earlier than expected, then all future expense will be recognized in the year of vesting. Sir, instead of 4 years, the share price was achieved in 3 years. Then recognize the expense in third year only full. If market condition delay, vesting period expense will be recorded as planned. Expense should not be delayed. Yes, sir. The technical marks is this one. See, market based condition. Market based condition have already been factored into the fair value of the equity instrument at grant date. Therefore, an expense is recognized irrespective of whether market conditions are satisfied. Market based conditions have already been factored in the fair value of the option at the grant date. Therefore, expense is recognized irrespective of whether conditions are satisfied. You have to write down this technical marks. So, non-market condition must be taken into account in determining whether an expense should be recognized or not at the reporting date. In non-market condition, we can reassess the thing. There is no such problem. Yes, sir. So, with this, your part is done. Any doubts to anyone in the recognition of expense over the period for market, non-market? Naina? Okay, chalo then. Now coming to sir, what will happen after vesting period? Sir, once vesting date is done, after that what will happen? So the employees will come and exercise the shares. See now, I say number of employees are 100, number of options is 100, fair value of the option is 10. Sir, fair value of the share is what? $1. Exercise price is 0. Exercise price is 0. So here till here the equity value is what? It is $100,000. Now this is the exercise period. In this period, employees will come and collect the shares. So if the option is exercise, sir, if the option is exercise price is 0. Sir, we remove the this part or not? Yes, sir, we remove the shares, equity part. We recognize share. How many shares are issued, sir? 100 into 100, 10,000 into 1. So the remaining will be what, sir? The remaining will be share premium. Yes, sir. Yes, sir. If exercise price is 2 rupees, if exercise price is 2 rupees, what will happen? Debit cash, sir, that is coming in 20,000. So share based payment, what we recorded $100,000. Share capital will be 10,000 and remaining will dump. We will dump into share premium. Simple. When it is exercise, in exercise, if the value is 0 or the value is 2 or 3 or 4. Sir, if the options are lapsed, that what we will do? Sir, we will reverse it. Do we reverse in PNL, everyone? When the options are lapsed, do we reverse in PNL? No, better. If it is during the vesting period, we can reverse into PNL. Once the vesting period is done, we can't reverse in PNL. The reversal will be done in what, sir? The reversal will be done in your retained earnings. Reversal will be done in what, sir? Your retained earnings. Simple. The reversal will be done in retained earnings. Yes, sir. So with this part is done. So with this, your first type of question is done. Down the second type, cash settled share based payment. Sir, in cash settled share based payment, what is the difference? Cash settled share based payment, cash is given based on share price. How will you identify in your exam if it is written SAR? If it is written SAR, yes, sir. See now, cash is given based on the share price. Yes or no? Yes, sir. Or we say cash is given based on the difference of the share price today and in future. Today the price is 10. Whatever is the increase in the share price, that will be given to you. There are two types of payment. But for exam focus, you have to remember this point. Then what is the difference in cash settled share based payment and equity? Let us understand that. Yes, sir. See now, during the exercise no, it is similar to equity settled share based payment, except fair value should be reassessed at end of each reporting period during vesting period. Sir, at each reporting date, the value will change. So fair value at each reporting date should be taken. During the exercise period, share based payment liability should be remeasured at each reporting date. Remeasurement gain or loss will be recorded in P&L. Payment of SAR will always be done on intrinsic value. Two important sentence. What will you write down? In case of cash settled share based payment, company will recognize the expense over the vesting period and as a liability in the P&L. Then the value of the liability at each reporting date will change based on the fair value of the option at each reporting date. Two sentences important. Yes, sir. So let us directly jump into the calculation and a basic question. See now, number of employees expected to fulfill into number of options into fair value of the option each balance sheet date into vesting period divided by total vesting period less expenses already recognized. We get current year expense. Sir, on grant date, will there be any journal entry? No such journal entry. So during vesting period, what we say? Debit employee benefit expense, credit P&L, share based payment liability. Sir, if it has to be reversed, we reverse it. Which category? Operating, sir. During vesting period, what do we do, sir? During vesting period, fair value will increase, fair value will decrease. Sir, if the fair value is increasing during exercise period, that means we have given the time period for 2 years. In that 2 years also we have to change the value. Investing period to we do baba, but in exercise period also भी करना पड़ेगा, we have to change it. So debit employee benefit expense, credit share based payment liability because the value is increasing. Sir, if it is decreasing, debit share based payment liability, credit employee benefit expense, simple. Then, sir, exercise date. What do we do in exercise date? Debit share based payment liability and credit cash. And this payment will always be done at what value? Intrinsic value. So we reduce the liability and at intrinsic value, this amount is done. And in your exam, chances are very high that this only will come because you know here, so a little bit complication is there. What is that complication? So remeasurement. Every year we have to revalue this. Every year we have to revalue the things. So see here now. Let me take a good example. Yeah, let me take the example number two. See now. On 1st January 2006, P granted 60 share appreciation rights. Sir, it is cash settled share based payment to each of its 200 employees on a condition that the employees work for P until 31st December 2007. So, for how many years employees should work, sir? 2 years. During 2006, 12 employees leave and P estimates that further 15 will leave. 12 have left and 15 will further leave. During 2007, 14 employees have left the company actually. So 12 plus 14 is how much? 26 employees left. Then, sir, on 31st December 2007, 61 employees exercise their SAR. Sir, on 31st December only employees are taking the SAR. Now you only say if the employees are taking the SAR, will you record the value at intrinsic value or the this one option? You will record this as the intrinsic value. 77 employees exercise their SAR on 31st December 2008 and the remaining in 31st December 2009. See, they are given the values. Now see, everyone, what should we do? Calculate the liability to be included, etc. We have to include the liability and say what is the value. So 200 employees, 12 left, 15 will leave. Into 60 per employee, options are given into 16.2, the fair value at the balance sheet date, not at the start of the date, into 1 by 2. 84,078, 84,078, yes sir. Then 200 minus 12 left, minus 14 left. This is how much? 177. Sir, out of this 177, how many employees are exercising today? Sir, employees which are exercising is 61. So 61 and 133. Sir, 61 into 60 into 60. Sir, here we take intrinsic value, bete. Here we take intrinsic value because these employees are taking the shares today only. They are taking the shares today only into 15.70 into what, sir? 18.10 for the remaining employees. Yes, sir. So we get the liability as what? This value. So the difference will be what, sir? This minus this is this. It is recorded into P&L as an expense. Sir, after these next year, what is happening, sir? How many employees are taking? So 77 employees are taking. Out of 170, out of 113, 77 employees are taking. In that case, what will happen? See, yes, sir. Sir, 113 out of the 77 are exercising into 60. 36 are remaining. If 77 are exercising, we pay at intrinsic value. Chalo, see intrinsic value kitna hai? So 19.80 is the intrinsic value. So 19.80 I record. I get what? 91,476. Then, sir, 36 into 60 into what is the fair value? 20.50, sir. And this we get the total expense, total abds 1,35,756, and we record it here. So the difference between these two is how much? Can I see the difference is how much? This and this, huh? Do not take this and this bete. Out of this, liability is paid. 57,460 it is paid. So the remaining liability will be how much in your books? 122,718. That is the remaining. And this you compare with this value. Avoid the silly mistake in the exam. This we take, sir. How much is the increase? The increase is 13,038. Sir, this is the value of the liability before the payment. Sir, after the payment, we'll reduce this. My liability will come to 44,280. Yes, sir. Sir, in the last year, employees are exercising. So 36 employees into 60 into 22. The fair value of the option and the fair value in the market, the intrinsic value will be same. So they pay how much? They are paying 47,000. My liability is reducing by 42, but I'm paying 47. That excess will go where? Again into P&L as a expense. This is in case of what, sir? This is in case of your cash settled share based payment. Any doubts to anyone in cash settled share based payment?
हाँ सर।
क्या डाउट है?
सर एक बार वो एक्सपेंस वाला और जो पेमेंट हम लोग की, एक बार उसमें कंफ्यूज हो गई हूँ। मेरा कुछ और अंडरस्टैंडिंग था। एक बार उसको रिपीट कर दीजिए प्लीज।
See here everyone. 200 employees है कि नहीं इधर? Out of that remaining are how much? 177. Sir, out of this 177, how many employees are exercising today? कितने employees ने आज exercise किया? 61. So this 61 employees, what is the value I'll be giving to them? Sir, intrinsic value payment 15.70. So I will directly record the expense at 15.70 only. I will directly record the expense at 15.70. So remaining are 113. 113 I will record at what? Are they exercising today? No, they are exercising future. So I will say what? 8 is at fair value. That is 18.80. So I calculate this. My total liability is coming to what? 1,80,180. So this is before the payment. Now, once I've calculated the expense on the same date, how much is the payment I will do for the 61 employees? So for the 61 employees, the payment is 57,462. I immediately do this payment. My remaining liability will be for this one. 122,718. Then next year, what will I do? Sir, out of this 133 employees, how many are exercising? 77 are and remaining is 36. The remaining employees will be based on the fair value of the option. But the employees who have exercised is based on what, sir? Is based on what? Is based on the intrinsic value. Again, I calculate my liability to be this one, but my closing balance is this one, because out of this total liability, sir, 57,000 we have done. Payment is done at intrinsic value. So remaining is this. And then again, I compare with this. I get expense of this one. Sir, out of this 135, what is the payment we are doing in this year? 91,476. My remaining liability is this one. Then next year, what I'm doing? So next year, these 36 employees are exercising into 60 into 22. I get 47,250. But so my liability was how much? My liability was 44,280. How much is the excess I'm paying here? Excess कितना पे हो रहा है? 3,240. That will be recorded as an expense. अभी समझ में आया?
हाँ सर, यही तो करती हूँ मैं।
हाँ तो वही तो करना है, और क्या करना है? दूसरा कुछ है ही नहीं. So with this, your first part is done. That is what, so the first part is done regarding cash, equity. Then second is cash done. Now share-based payment with cash alternative. Very easy thing. Follow the first step and then remaining it's same, sir. See now, cash settle. Entity will have a choice. When entity will have a choice, what will the entity do? Entity will always try to give what? Entity will always try to give what? Entity, if the entity is saying we will give shares only, then follow equity settled share based payment. If the entity is saying that we will give cash, then follow cash settled share based payment. But from a general common sense, we say entity will always follow what? Cash settled, equity settled share based payment. Why? Because they want to maintain liquidity in the business, they want cash in the business. That is the reason. Sir, counterparty will have choice. Sir, counterparty means what? You have the choice. If counterparty has the choice, like hybrid instrument which we have done, entity should record both what? Entity should record both equity and entity should record both equity and liability. Entity should recognize both equity and liability. Chalo now. How should we do the split accounting? Let us understand here. Yes, sir. See now, counterparty choice has in that case, what should we do? Listen. Share-based payment transaction in which an entity provides a choice to the employee to take entity's equity shares of cash on an on entity share price. It should be treated as a compound instrument. Compound financial will not say financial here. It's compound instrument. Do not include that term. That is in your IFRS 9 simple. So step 1, step 2, and step 3. Step 1 is what, sir? Calculate present value of the equity option at granted. Simple. Remember. So we calculate the value of equity, we calculate the value of equity option and that date, we calculate the value of the liability on the same date. We compare these two. Always equity will be more. always equity will be more. Why? Because the company will give equity shares more, so that the holder will always choose equity, because the company can save cash in the business. Every time equity will be more only. So how do we calculate this? Number of equity options into fair value of the equity settled on grant date. What is the fair value of the equity settled on the grant date? That the fair value of the option. Step 2 is what, sir? Calculate fair value of the liability option in how do we calculate number of option as per cash settled share based payment? Sir, as per cash, if I take cash, how many options are given to me? Into the fair value of the cash settled on the grant date. For cash settled, what is the value? So then step 3 is what? The difference between this two is what, sir? Is what your equity part. It is what equity part. So see the accounting. So for value of the equity, we follow what, sir? Equity settled share based payment. So for cash settled share based payment, what should we do? Follow the normal accounting method. Whatever we have learnt about, follow the same accounting. Follow the same accounting. Simple. Follow the same accounting. No issues in that. चलो then let us do a question so that you get to know कि सर क्या है क्या नहीं है इसका फंडा. देखो, on 1st January 2004 an entity grants a right to 20 employees. How many employees? 20. If still employed on 31st December 2006, the employees can elect to receive either 800 options. Okay, 800 options. So this is what for equity, yes, or cash to the value on the date of 700 shares. So for equity option, if you take, you get 800 shares. For liability, if you go, you get 700 shares. The fair value of the option is 19 at the grant date. Yes, sir. The reporting date is 31st December and the share price is what, 21. So now everyone say me, how will I calculate the equity value? 800 into what? 19, sir. 700 into what? 21. कितना आ रहा है ये? As I mentioned, equity value is always more. So how much is this, sir? 500. How will you account this for 500, bete? How will you do the accounting for this 500? As per equity settled share based payment. Will you again multiply dollar value here? Huh? Will you again apply dollar value on this 500? डॉलर वैल्यू अप्लाई करेंगे क्या इसके ऊपर 500 के ऊपर? Only consider the number of employees. Only consider what's the number of employees and the vesting period. See now. So it that is 20, 18, 17 we have to consider. See now. So the fair value of the equity was 500. Only apply number of employees. Do not go with this. Yes, sir. Fair value of the equity component is what, sir? 500 per employee. Fair value of the equity component is what? 500 per employee. So equity component has been valued at the grant date and will be recognized over the vesting period. Yes, sir. For 3 years. Liability component will be measured at each reporting date and recognized as an expense over the period. So see, so 20 employees are expected to vest here at the first year end, and then 18 and then 17. So what will I do? See. Chalo dekho idhar. So 500 into 20 into 1 by 3. Sir, this will go to P&L, this will go to balance sheet equity, sir. Then for cash settled share based payment, follow the normal accounting, Baba. So 20 into 27 into 700 shares. 20 employees, price is 27 at the year end, 700 is the shares into 1 by 3. Then, sir, year 18 are expected into 500 into 2 by 3. Yes, sir. Excess is how much? 2667. Year 18 into 700 into price is how much? See, 33. किधर है? ये रहा देखो. 27, 33, 42. I'm doing on that basis. Yes, sir. I have record on that basis. Now see, till for third year also we have done, sir. After 3 years, what will happen? Sir, either employees will take what? Sir, either employee will take cash or either employee will take shares. Out of this, any one they will take. No, it's not that we'll provide both the things. Understand? Sir, employee will take cash. If employee will take cash, what will I do? Sir, what is the cash payment? At the year end, the fair value of the option and the intrinsic value will be same, Baba. It will be same. Understand? Yes, sir. So debit financial liability and credit cash going out. So what we will do for equity reserve? Reverse it. So what we will do for equity reserve, simply reverse it बेटे, reverse कर लो उसको, simple. Yes, sir. Sir, if employees will take shares, what should we do, sir? First, remove the liability part. Sir, remove the liability part and take it to reserve. Sir, I have taken to reserve, sir. Simple. Then what do we do? Sir, reserve you have to eliminate because the value is increasing. Eliminate. Give what, sir? Share capital. How many shares we are giving, everyone? How many shares we are giving? Huh? How many shares we are giving? See here. These are the number of shares which we are giving. Why have written 13,600 here? The number of shares is how many here? 1 minute ruko. Okay, sorry, my bad. Number of options is how much? 800 into 17. How many employees will exercise? 800 into 17. Options per employee is 800 into 17. Number of employees taking. That is 13,600. I will record it and the remaining will directly go to what's the remaining will directly go to your share premium. Simple. The remaining will directly go to what? Share premium. And we have recorded this directly the other balance to premium, sir. With this also done. So see now, reverse it. Share capital recorded, share premium. Same we have learned. Reverse it. Yes, sir. Then coming to share-based payment to other parties. Share-based payment to other parties. Sir, share-based payment to other parties, what we say, sir. When entities do share-based payment for purchase of any asset, goods or service, recognize asset, good or service acquired at fair value of the goods or service. Yes, sir. That is direct method. Do you remember your IFRS, this one? 15. Record the revenue based on what? Fair value of the item received, non-cash consideration received, same thing here. But sir, if that is not available, then fair value of the shares which are given. Yes, sir. So see now, if company A is purchasing a PP, how we will do the accounting? The PP fair value is what? 10,000. So the asset is recorded 10,000. How many shares we will give? Sir, we will see the number of shares given. If I say we give 1,000 shares into 1, sir. So my share capital will be 1,000. My share premium will be what, sir? 9,000. Frequently tested this question. Cash settle and these two are frequently tested. In your pre-mock also question is there. In your pre-mock, IFRS 2 share-based payment is that. IAS 19 employee benefit is that. IFRS 15 revenue is that. सब कुछ है. IAS 37 is also that provision. And I mentioned that this 37 is very important. Yes, sir. IAS 12 taxation is also there. Leases है क्या? I have no such idea. But I know कि हाँ, these are the basic questions which are tested and it comes in the exam. If one said this is that, the other said some other thing will be there. And when coming to revenue, you have to be good with each and everything. 5 steps. Then step 2, step 5. In step 5, what did we discuss? Sir, theory part, calculation, input output method, then special cases. Be good with that. Yes, sir. So chalo, with this, your share based payment is done, madam. Understood? Kisi ko kuch doubts? I hope within 40, let's take 40 minutes, we are able to do a good revision of share based payment. That was an important standard. Now, which
सर
standard? Yes, बेटे.
तो जो स्पेशल केसेस है रेवेन्यू वाला में,
हाँ हाँ.
उसमें सर कंसाइनमेंट वाला जो कॉन्ट्रैक्ट होता है और प्रिंसिपल एजेंट वाला जो कॉन्ट्रैक्ट होता है ना, उसमें बहुत कंफ्यूजन हो जाता है बार बार।
अरे दोनों लिंक नहीं करना है, दोनों होता है लिंक. यू कैन रिलेट बोथ
हाँ
द
सर,
थिंग्स
वो
टुगेदर.
दोनों में कंफ्यूज हो जाती हूँ, डिफरेंशिएट नहीं करने पाती हूँ।
अरे प्रिंसिपल एंड सी, when coming to principal agent, we only see the amount of revenue. Yes or no? When we see principal
सिर्फ
and agent,
कमीशन जो मिलता है एजेंट को वो
yes.
रिकॉग्नाइज करता है।
So when we see principal and agent, can I say we see only one thing? What is that one thing? What is the amount we should include in revenue? Do we see when should we recognize revenue in principal and agent? Everyone? Nine. If I am a principal and agent, when we use the concept of principal and agent, I only use this to calculate the amount of revenue. Do I calculate this to recognize the revenue? No. Consignment arrangement is based on what? Consignment arrangement is based on when should you recognize the revenue. Principal and agent, we see what, sir? Principal and agent, we see the amount of revenue. When coming to consignment arrangement, we see what? The When should you recognize the revenue? What date? Timing. Consignment will talk about timing. Then your principal and agent will talk about amount.
ओके सर। सर टाइमिंग एज इन जब
कब रिकॉर्ड? ओवर द पीरियड आपकी।
कंसाइनी कंसाइनी जब माल ट्रांसफर कर देता है टू दी थर्ड पार्टी।
यस बेटे, यस यस। चलो देन, विद दिस इज डन। अभी कौन सा करते हैं? विच स्टैंडर्ड शुड आई टेक? सेम ही।
सर IAS 37।
IAS 37। IAS 37 करते हैं ना, पहले ये करते हैं IFRS 8 ऑपरेटिंग से। A very important standard for December attempt. Three types of questions are there. याद रख लो, हो जाएगा काम सिंपल, ज्यादा प्रॉब्लम नहीं। So chalo chalo chalo, now starting with your revision of your IFRS 18 segment reporting, a very important standard. There are three types of question which you have to basically understand, do and go. और उससे बाहर कुछ आएगा नहीं, and it will come from that only. Yes sir. Now I'll not go into the detail part, etc. Sir, what is the objective, sir? Sir, what is the objective of this standard? The objective of this standard is to provide better information to the users, to provide better information. What is the nature and the financial effect of the entity business, in which all segments they are doing the business, and what is the economic environment in which the entity operates. Simple. So the first type of question is that the definition, whether it is an operating segment or not. You have to identify whether it's an operating segment or not. When will you say it is an operating segment, sir? It is a component of an entity, generates independent cash flow. It is a component of an entity, sir. Then it that engages in business activity from which it may earn revenue and incur expenses. It may, it's not for sure ki revenue should be there. Yes, sir. Then whose operating results are regularly reviewed by a COTM. Why will he review? Sir, he will review because he want to decide what is the resource I have to allocate. Simple that. For which discrete financial information is available. You have to mention this one or two technical marks. If the question requirement is for 8 to 10 marks, then write down in detail. If not, then write down simple. Operating segment is a component of entity that engages in business activity and earns revenue. Then whose operating results are reviewed by CODM, then discrete financial information is available. Simple. Yes. See now, sir, segment activities, sales can be to internal as well as external. No problem in that. So segment can be identified using various criteria, such as the type of product or service, geographical area, customer group, etc. Then coming to, sir, will head office research and development be this one? No, these all will not be an operating segment. Ignore it. A segment can still exist if it's not earning revenue yet. Yes, in case of startups, we have seen that. Sir, in CODM, is CODM a job title? Is CODM a job title? No, bete. CODM is not a job title. CODM is a role or a function which is given either to a group of person or a individual person. So CODM is a person or a group that decide how much money or resource should be allocated and reviews the performance. Yes, sir. Simple. So the first type of question is done. See, how should you answer this? Class में बताया था मैंने. Type 1, identification of operating segment. Write down these key points. Link to the case, whether income is there, whether CODM is reviewing separate financial statement. Conclusion, give it that it is a qualifying loss. It is an operating segment. That first one. Then coming to aggregation, sir. In aggregation, what do we see? So the type 2 question, yes or no? Yeah, type 2 question. In aggregation, what do we see? Sir, we have identified that there are a lot of operating segments. Now, what should we do? We should aggregate it. Now, when you aggregate, there are some principles which we have to follow. See now, what are the three things? Two or more operating segments can be combined into one if the following three conditions are all met. Three conditions are what, sir? First is the it should be it should support the core principle of IFRS 8. What is the core principle of IFRS 8? Useful information should be provided. Judgment, apply the judgment whether it will provide useful information or not. Simple. These segments have similar economic characteristics. The examiner will play with you in this point only. Similar economic characteristics. Similar economic characteristics means the profit margin should be same. Risk and growth trend should be same. It's not identical. It is similar better. If it is 7 and 8, if it's 7 and 9 also, it is okay. Then, similar in key operational aspects such as nature of product or service, nature of production process, type of customer served, etc. Then method of delivery, transport, etc. Then regulatory environment they operate under. Yes, sir. So you have to see these things. What is important? core principle should be satisfied, similar economic characteristics, and this should be similar. Yes, sir. It's not that all the thing will be similar. Huh? It's not that each and every point will be similar. Here and there some difference can be there. It's okay. No issues in that. Yes. So aggregation, this is the second type of question. How should you answer? You have to mention operating segments should be aggregated in two or one if three conditions are being fulfilled. That is, aggregation should support the core principle of IFRS 18. Then the segment should share similar economic characteristics. In bracket, give one or two example. Then there are similar key operational aspects. Do not waste your time writing each and everything in the exam. Do not waste time writing 6 points also. If out of these 2 points are linking to the case, saying there are 2 points only in the exam, link that only. Do not waste time. If you have time, then no issues. But I say do not do that. Then link to the case and give your conclusion whether they can be aggregated or not. Yes, sir. Done with this also. Then quantitative threshold, sir. Once we have decided it is a operating segment, then what should we decide, sir? We have aggregated. Then we have to decide whether we should report this or not. Whether we should report it, yes or no. See now, reportable segment criteria. An operating segment is reportable if it meets any of the following quantitative threshold. What is the first threshold, sir? Revenue. Segments, the segment's total revenue means internal external is 10 percentage or more than 10 percentage of the combined revenue of all the segments. Consider all the segments, calculate the 10 percentage and see whether it is equal or more reported. Then, sir, asset. Segments asset is 10 percentage or more of the combined assets of all operating segment. First go with revenue, then go with asset, then come to profit and loss better. Yes, sir. Profit and loss says what? There are 10 segments. 3 segments are loss making, 7 segments are profit making. Take the profit of 7, take the loss of 3. Do the total. Now see which one is higher. Remove the negative sign, positive sign. Just see the number. Sir, the loss one is more. That is 7,000 loss. Profit is only 6,000. 7,000 is more into 10 percentage. So 700. So then compare whether the profit and loss is 700 or more than 700. If it is 700 or more than that, report it. Simple. So segment profit or loss is equal or equal or more than 10% of the greater absolute amount of the combined profit of all these segments and combined loss of all these segments. Yes, sir. Then what is the one more important rule? Examiner has mentioned that whenever we give this question, many students ignore this 75 percentage rule. Now everyone, should all the conditions be met or any one? All the three should be met or any one?
Any.
पर कोई सा भी
Any one. Do not go with that sense. Yes, sir. So 75 percentage external revenue means what, sir? At least 75 percentage of the entity's external revenue must be included in reportable segment. At least 75 percentage of the entity's external revenue must be reportable. Now you have already reported. Let's take you have reported 6 segments. You have reported how many segments? 6 segments. Now these 6 segments will report what? External revenue or not. Now check whether the external revenue is 75 percentage of the total external revenue. Yes, sir. See now, let me here are revenue, asset, profit we have done, then 75%. See here now. These all segments are reportable. One, two, three, four, sir. Yes, sir. These all are reportable. Now, what is the total here? What is the total if I do? Let me do the total. Give me 1 minute. 800 plus 100 plus 300 plus 20 plus 40 plus 200 plus 100. So this total is how much? External total is what? 1560. But what is the reportable? One we have reported. 800 plus 300 plus 100, 1200 and 1000. Some or the other mistake. 800 1300, yes sir, 1300, and it becomes 83%. Can I say it is more than 75 or not? Yes sir, it is more than 75. Is there requirement to include any other segment? Is there any requirement? No. But if I mention if it was less than 70, if it was 70 percentage, then what we will do? Then I will report F also. Then what will I report? I will report one more segment separately, F. So still it is not being met. Then I will report what E. So still it's not equal. Then D. Until and unless it is showing 75%, I will disclose it. Yes, sir. So with this is also done. This is also done. Then past papers which are important, which we have already done. Dario and these all class and सब कुछ कर लिया अपन class में. So with this, your IFRS 8 revision is done. There are three type of question. Focus on that bit. Other than this, nothing. Yes, sir. So with this IFRS 8 also done. Now, which topic? Which topic? Which topic? Which topic? Which topic? IFRS 13 fair value. Chalo, 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 chalo. Now, coming to the most important standard for SBR, IFRS 13, a very important standard for your exam. When we started our syllabus, we started with this standard only because we have seen that in each and every standard, we have the concept of fair value. Yes or no? Yes, sir. So IFRS 13, fair value. So what does fair value means? Directly, we'll jump to the definition. Okay. Before that, IFRS. See this standard IFRS 13 will teach you how to determine the fair value. Will it teach when to apply? IFRS 13 will not say you when to apply IFRS 13, when to apply fair value. It is as per respective standard. This standard will teach you the calculation of fair value. Yes, sir. So see now. Excuse me. IFRS 13 will not apply to IAS 2, IFRS 2 share based payment, IAS 36 value news, and IFRS 16 leases. Because there also we follow the present value concept and record. Simple. Then, sir, definition. What is this? What is this? Fair value is the price to sell an asset or paid to transfer a liability between market participants in an orderly transaction on a measurement date. On a measurement date. So price means what, sir? Price means exit price. When I exit, when I sell it. So market means what? Principal market or most advantageous market. Sir, participants means what? So participants means buyer and seller. The buyer and seller should have knowledge. Both buyer and seller should have knowledge. Today I am selling an iPhone today to you, but you do not have any knowledge. Instead of selling this iPhone for 1 lakh, I'm selling this for to you for 5 lakh rupees. That means you have no knowledge about that. So both the parties should have knowledge, as well as the transaction should not be under any stress or any force. It should be a orderly transaction as per the market terms, a normal transaction. It should not be a force. It should be at arm's length, sir. Measurement date, yes. So is your IFRS 13 calculated for the period? No, it is not for the period, bete. It is on a specific date. Today I go to the market, I get the fair value. I can't say that value was for the full year. It is at that date, yes, sir. So I hope the fair value is definition is clear. Whenever a question comes, bete, you have to write down this. You have to write down this. Yes, sir. Then everyone, see now. So what is the concept of principal market? Principal market is what's a market where the number of transactions are more, where the transactions are more. Yes, sir. So then most advantageous market means what? Market where the return is maximized. Market where the return is maximized. Then what is the next thing? The next thing is what? An important thing. When we calculate the fair value, we should consider asset specific restriction, not entity specific restriction. A very important point. When we calculate the fair value, we should consider entity asset specific restriction, not entity specific restriction. Yes, sir. See now today, this car is there with me. I have a car. For this car, I have to calculate the fair value. Now I say that for this car, the company I am using this car, I say that I will not use this as per taxi. I will not. I use for my personal use. I will not use as per taxi. It is not a taxi. Now now when coming to the fair value for this taxi is more. In the market, the fair value of the taxi is more. Now say me, this taxi car restriction is asset restriction or entities restriction? Which restriction is this? Is this asset restriction or entities restriction? It is entities restriction. It is an entities restriction, so I will not consider this. When I calculate the fair value of the car, I will calculate as per the taxi also. If the fair value is more, I'll consider that. Yes, sir. So with this part is done. Okay. See now, the first type of question. How to answer IFRS 13, question number 1. IFRS 13, fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants. Fair value is entity specific, a market specific, not entity specific. Then mention whether the question is what regarding what's a principal or most. Principal market is the market where the volume is more, fair value minus transaction price. For most advantageous market, what should we do, sir? For most advantageous market, first we have to identify which market is the most advantageous. How will we identify? So market price less transportation cost less transaction cost, we get the net proceed. I have three markets, I have calculated this, so I identify this market has the highest benefit. Then how will I calculate the fair value? I'll calculate market price minus transportation cost. This is the first type of question that comes, very rare, a easy question that can come in your exam. So the question we have done regarding this, yes sir. Okay, okay, yes. There is no doubts in this, sir. We have done this. We have done the market also. Yes, sir. Now coming to when determining the price of the asset or liability, a very important point. Level of hierarchy. Level 1 says what, sir? The value which you calculate should be based on observable inputs. Observable input means what? Which is considering the market data. It is considering what's a market data. So observable inputs will calculate on that basis. So what will I say? Quoted price of the identical assets or liabilities in an active market. In an active market. So identical means 100% same. So when coming to Reliance company, Reliance shares are listed, it is same only, no? It's identical, sir. Observable inputs. The priority should be given to level 1. Sir, if level 1 is not available, sir, Reliance company is not listed. Sir, Reliance company is into IT business and IT business is not listed. What we will do? Sir, we will go with level 2. In level 2, we see what? In here also observable inputs, but what we do here? Adjustment. What will I do? I will take TCS share price and I will adjust. Because Reliance is also into IT. It's not into IT. I'm just taking an example. Reliance is into IT, TCS is in IT, TCS is listed. I'll take TCS share price, I'll adjust it. So quoted price for similar assets in an active market or quoted price for identical assets in a less active market. Sir, Reliance share price is that, but Reliance share price is not traded only, sir. In 3 months, one or the other customer will sell. So in that case, I will take that price, I will adjust it because the data was about 3 months old. Now the data will be fresh. Some other points we have to consider. Then we say level 2, sir. If level 1 is not available, level 2 is also not available, then we go over level 3. And level 3 is given the least priority. In level 3, what we see, sir? Excuse me. Whatever are the future cash flow, we will take it discounted. Whatever are the future cash flow, we will take it and discount it. Yes, sir. Done with the level of hierarchy. So in your exam, how will the question come? Sir, level 2 data was available, but they have calculated the fair value based on level 3. So mention the directors are wrong, etc. We have to calculate based on level 2. Then coming to non-financial asset bidding. In non-financial asset, what do we see? Like your PP, etc. property, how do we calculate the value of the land? Sir, whenever coming to non-financial asset, we have to consider the highest and best use, sir. We have to consider the highest and best use concept. Highest and best use का meaning क्या है? Sir, highest and best use means what? One important point. Highest and best use, when will you say? When three conditions are being met. It is physically possible, legally permissible, and financially feasible. Sir, it should be physically possible. If I have agriculture land, can I turn this into a factory? Sir, nearby there are apartments only. Is it possible? You only say. It is legally permissible, not sir. It is financially feasible. Yes, sir, it is financially will get more profits. But it is not legally possible, legally permissible because government knows nearby apartments are there, they will not let you to construct a factory or anything. So in that case, we will say no. All the three conditions should be met. Then we say the criteria is being met and we will consider that value. And when you consider non-financial asset, bete, if you convert that property, see now, in class we had taken the example non-financial asset. Yeah. See now, this was the example, 5 quarters example. Now, when I want to convert this, I have to incur an expenditure of 0.3. So, my fair value kitna ho jayega? My fair value will be what? 6 million minus 0.3. 6 minus 0.3. So, to convert this into residential, I have to expend. Some expenditure is required, 0.3. That I have to minus and then take the fair value. So, transformation cost will be reduced. So, transformation cost will be reduced from the fair value to get the actual value. So with this, your non-financial asset part is also done. Then this is also done. Then what is the last topic from this? So what are the valuation techniques? Valuation techniques are the market approach, cost approach, income approach. So market approach will always talk about the exit price, IFRS 13, which you have seen. Cost approach, replacement cost. If I go to the market and purchase the same asset, at what value I'll get this? Then income approach, present value, the future cash flow. Yes, sir. What are the steps? First, identify the asset or liability. Then identify whether it's a non-financial asset or not. Then identify market. Then apply the valuation technique, whether market, cost, or this. Income approach is very rare. We all follow market only most of the time. So, what is the agenda? Maximize observable inputs and minimize unobservable inputs. Whenever a question comes regarding hierarchy, you have to mention this bit. You have to mention this. Then fair value of the liability, rarely tested as mentioned. Sir, how do we calculate the fair value of the liability, which we have used in IFRS now? Now, did you get a link or not? In fair value, what do? We take the value and we discount it. Yes, sir. If there is an active market of the liability, then use the quoted price. If any liability is listed, if I say I've issued a bond today and these bonds are listed on the stock market, I'll consider that as the fair value of the liability. Yes, sir. That is the reason you can see in IFRS 9 we have seen your debt instruments are recorded fair value through P&L. Mostly what? Mostly derivative contracts. Yes, sir. Then coming to next, if your liability is an asset for someone and that asset has an active market, then use that asset price with some adjustment as fair value for the liability. So whenever I say your liability is an asset for someone, then use that price. If the liability is not listed, yes, sir. Then, sir, if that is also not there, then what should we do? Discounting. We have to discount the future cash flow using which rate? Using which rate? So we use risk-free rate plus company's non-performance risk. We use risk-free rate plus company's non-performance risk. Yes, sir. Other than this, nothing. So we have taken an example in the class. Yes. Then coming to fair value of decommissioning. Can I say not tested in one of your paper? It has been tested, so that is the reason we have done this in a class. In IAS 16, not done. So listen, bus. If you know, good. If not, भूल जाओ. Quite no worries about this topic. Expected labor cost I take, overheads I take, the profit markup I take on this. Then I'll add any premium for the risk of the cash flow. Sir, whenever I want to do decommissioning, I will have a labor cost, overheads, and I will charge a profit also on that. And I have a risk, sir, whether the cash flow will remain same or there will be an effect. That also I consider I get real cash flow. Then these real cash flows are inflated based on the inflation rate. Yes, sir. Because see, there are two things. Inflation we apply as well as a premium saying, sir, I mentioned that okay, it will cost 10,000, but it can cost 11,000 also. Then normal inflation we apply, then we discount it by using which rate? Risk-free rate plus company's non-performance risk. Risk-free rate plus company's non-performance risk. We will use this and we will discount the value. So with this, your IFRS 13 is also done, and in the class we have done this. Sitka, Mehran, JH, Yenong, and African company. Yes, sir. So IFRS 13 is also done. किसी को कुछ doubt in IFRS 13? No? Okay, then chalo, let us take a break. Come back and do IS 37 and then one or two more small standard. With that, this will be done. आपका IS 37 किधर है? So now the time is what? 11:18. Everyone be back by 11:30. After that, we will do IS 37, IS 38, then 20 and 23. Chalo, chalo, everyone come back. Yes, okay. Others, yes or no? Gia, Kashvi,
Yes, sir.
yes.
Yes, sir.
So let us start with the next topic: provision, contingent liabilities, and contingent assets. A very important topic. Very, very important topic. Each time we see a question. Chalo, no. This standard will talk about provisions, contingent liability, and contingent assets, accounting and disclosure part. Now let us jump into what does provision mean. So provision is a liability of uncertain timing or amount. Whenever the timing or amount is uncertain, it becomes a provision. So what does a liability means? A liability is a present obligation arising from past event where we have to transfer some economic resource. Now obligating event means what? When either it's a legal obligation or constructive obligation, we have no realistic alternative rather than settling off. If I have a choice, I can escape from it. Will it be provision 9? I have no alternative option. I have to do the settlement. Then only we say what it is, sir. A liability, sir. Simple then. So, chalo, 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 chalo. Now, there are two types of obligation: legal and constructive. Legal obligation means, sir, because of a contract, because of any law, regulation, etc., we have an obligation. Constructive obligation means, sir, because of any past event, published policy, any specific current statement we have given, which creates what? Which creates a valid expectation, it becomes a constructive obligation. So in the question, you have to identify whether that is a provision or not. How will you identify? Sir, obligation is there or not? Past event, sir, whether we can estimate the amount or not, etc. See now. Recognition. Now, whenever a question comes regarding provision, what should we do? A provision shall be recognized when an entity has a present obligation, legal or constructive, as a result of past event. It is probable present obligation, past event, probable that an outflow will be the and reliable estimate. If all the four conditions are being met, we recognize provision. If not, directly we take into penal as an expense. Sir, what does an obligation means? Obligation means no alternative only of settling. You have to settle. If you have to settle, then that means for sure outflow will be there. It is probable that we have to pay. Yes, sir. So we have done a lot of questions regarding this, etc. How to then coming to measurement. Sir, measurement. What is the journal entry? Beta? Debit expenses credit, debit expenses or debit as a credit provision. Simple. Then measurement, sir. How we will record this? Provision should be recognized at a best estimate. Yes or no? Provision will always be recognized at a best estimate. How do we do this calculation? There are two methods: most likely outcome and expected value outcome. Most likely outcome when there are two outcomes. Either one we select. In case of expected value, there are multiple outcomes. We have to select any one. Simple. Yes, sir. We will apply present value concept here. Yes, we will apply present value concept when, sir, when discounting is involved. When discount will come into picture, when the time period or the time value of money is there, when the period is more than 1 year, the gap is more than 1 year. Yes, sir. So which rate we use entity, the asset specific regarding to that asset, we will use that and we will record unwinding cost in financing capital. Sir, provision is an estimate or not, better? Yes, sir. Provision is an estimate. In that case, what should we do? So provision is an estimate at each balance sheet date. We have to review and we have to reassess the value. Any changes that we will take to penal. Yes, sir. Or if not any reversal is that also will take to penal. Yes, sir. So with this provision partition, then contingent liability. Yes, sir. Now see everyone, in contingent liability, what should we keep in mind? So when will we say contingent liability? A present obligation that arises from a past event but is not recognized because. So a present obligation is that has not been recognized. Why we have not recognized a present obligation because of past event? Because, sir, amount is uncertain. Present obligation, past event, it is probable that outflow is there, but amount we can't estimate, sir. Sir, present obligation, past event, amount we can estimate. Sir, it is not probable that the outflow will be there. In these cases, we say it is contingent liability. Yes, sir. Then what is the other thing? Sir, a possible obligation. Possible obligation means what? When will you say the obligation is possible? I say that I will pay you 10,000 if this student will get what? A rank in SBR. So can I say here the obligation on me? There is an obligation to pay you. But is this present? Nahi, Baba. This depends on a future outcome, and that future outcome is not in my control. I say what this is a possible obligation, which exists or will confirm only by occurrence or non-occurrence of one or more uncertain future events, not wholly controlled by the entity. I can't control it. Yes, sir. See now, in your Now, everyone, I say that today a company is there, a factory is there. This this factory will purchase some smoke filters. This factory will purchase some smoke filters in future. Smoke filters as an asset. So in future they will purchase. Can they record a provision? Can they record a provision for this? If the entity is saying that we will purchase smoke filters in future, can
No,
they record provision on this?
no.
No. No, sir. No. Yes. Your answer is right. Yes. Now I say, now these smoke filters, why are we purchasing? Why this company is purchasing smoke filters? Because to reduce CO2 emissions. A basic understanding to reduce CO2 emission. Or to whatever is the emission, it will reduce. This smoke filter is designed in such a way, it is a new technology which will reduce the carbon dioxide or the emissions by a lower percentage. Some That is some technology, yes sir. They will say now. Now the entity is saying that this factory is saying that our pollution is more. Yes sir, our pollution is more. Now they mention that we have to purchase carbon credits. We have to purchase what? Carbon credits. We have to purchase what? Carbon credits. Now the entity is saying pollution is more. We have to purchase carbon credits in future. In future, yes, they want to purchase carbon credits, ki so this much is the oxygen, if this is the carbon credit, you can offset, etc. A lot of things. Will not go into that now. They are saying that we'll purchase in future. Now the company is saying that the company is saying that if we purchase in future the carbon credits, it will cost us $10,000. And the company is saying that this carbon credit depends that whether we will purchase this smoke filters or not. The company is saying today the carbon emission is what? 100. So we need not purchase. But the carbon emission becomes 300 in future. At that time we need carbon credits. But if we purchase the smoke filters, our carbon emission will come down to 100. Now say me everyone, for this you mentioned sir we will not record provision. For this in future you want to purchase carbon credits, will you record provision for this? We are saying that carbon credits we will purchase when if the emission is more than 300. If the emission is more than 300, etc. And the question is also saying that if you purchase this smoke filter, you need not purchase this if you need not purchase this carbon credits if you purchase the smoke filter. If you can purchase smoke filters, then no need to purchase carbon credits. Now for this you mentioned no provision. For this carbon credits, will you recognize provision?
सर ऑब्लिगेशन है हमारा लीगल.
Okay, you're saying legal obligation is there. Others
सर
say
अगर गवर्नमेंट
But sir,
मतलब
we can avoid it.
we can avoid. Okay.
सर
Is
अगर
this a,
गवर्नमेंट बाइंडिंग कर देगा तो हमारा मतलब लीगल ऑब्लिगेशन हो जाएगा.
I did not mention anything. This is the data which I've given. You should see simple. वो गवर्नमेंट का वो ज्यादा नहीं सोचना. You should not go in detail. Can I say the purchase of credits in future is an obligation, you say, sir? Is this a present obligation or possible obligation? Can I say this purchase of CC depends on some future event or not? Yes or no? This purchase of
यस.
carbon credit depends on future event. And is that future event in your control? Sir, carbon emission, yes, sir. But they're saying that this smoke filters are purchased, then no need of this carbon credits. No need of. Can I say everything is based on future year? So it's what a possible obligation. You'll not record a provision on this. See, I have given less data. When coming to exam, it will be clear. Huh? I have just given an idea. I can't now be my detail में नहीं करूँगा. Basic idea I've given, sir. If it is based on future event, do we recognize provision? No, it's a contingent. So this way questions can come. If a sustainability etc. can be linked this way. Then chalo sir. With this, your contingent liability is done. So contingent liability, what should we do? See now, if it is excuse me, If all the four conditions are being met, provisions. If any one is not being met, contingent liability, contingent. No accounting entry, only disclosure is provided. No accounting, only disclosure is provided. Same thing for asset also, sir. Same thing for asset also. Same thing for an asset also. Contingent asset. Contingent asset means what? A possible asset, sir. Possible asset means in future I will receive. The amount which I receive will depend on one on some future event, and that is not in my control. So in contingent asset, what we say, sir, if in contingent asset, if it's virtually certain, we record as an asset. An entity shall not recognize a contingent asset, but it will disclose. But it will not recognize a contingent assets also when? In case of possible and in case of remote. If contingent asset is disclosed, where an inflow of economic benefit is probable. Yes, sir. So see this flow chart. Sir, outflow and inflow. If it is outflow, if it is remote, do nothing. If it is possible, contingent liability. If it is probable, provision. If it is probable but amount cannot be calculated, then contingent liability. So virtually certain, we recognize a liability. Then inflow, do nothing, do nothing. Sir, it is probable, contingent asset. If it is virtually certain, an asset we record. So with this, the definition part is done. Now coming to the special cases which are frequently tested. So reimbursement. Sir, can I record the reimbursement as an asset in my book today? Yes, beta. I can record this as an asset when? When it is virtually certain that I will receive the amount. If it is virtually certain that I will receive the amount, I will record it. If not, I will I will do what? I will ignore it. Yes, sir. See the accounting. Sir, in balance sheet, we have to record it separately as a separate asset and a separate provision. If I have a reimbursement on a provision case only, I record it separately. But in penal, we can do the net off simple. So reimbursement and then onerous contract. Onerous contract, a very important topic. So in onerous contract, what we say? So the contract in which the unavoidable cost of meeting the obligation under the contract exceeds the economic benefit expected to be received from it. So I say whenever I have a contract and from that contract I know that it is a loss making contract, either I will make loss or either I'll exit it. If I make loss, what is my total loss? Net loss. Or what is the penalty which I have to pay and exit the contract? So which one we will choose? We will always choose the lower one. If I fulfill the contract, this is the loss. If I exit, this is the loss. So out of this, the lower one we will choose and record this as a provision. We can recognize this. Yes, sir. So this part is done. Then coming to restructuring better. What does restructuring mean, sir? Restructuring is a program in which what? It changes the scope of the business or manner in which we do the business. Sir, I know that in future we will be doing restructuring. Can I record it as a provision? Can I recognize the expense today only? Can we create a provision? Yes, better. When the conditions are being met. What are the conditions? So detailed formal plan should be there and valid expectation should be there. Detailed formal plan should be there and valid expectation should be there. Yes, sir. So detailed formal plan means each and every detail should be mentioned. Valid expectation means, sir, it should be announced. Either it is announced or either the restructuring has been started. If restructuring has been started means okay, everyone will get to know. Or if the announcement is done, we recognize the provision. So what is the provision amount? Provision amount will be what? Only the incremental cost necessarily incurred by restructuring, not associated with ongoing activities. Anything which has the cost which has any relationship with the ongoing business, exclude it. It should be only incremental, specific to that. Because we are doing unwinding, we have to incur the cost. Like retraining, relocation will be ignored. Then your marketing cost will be ignored. Then cost in new investment will be ignored. Operating losses will be ignored. All this will be ignored. Yes, sir. So with this, your restructuring part is also done. Then future operating loss. Can you recognize provision for future operating loss, Bete? No, sir, because we need not pay anyone and it is based on a future event, not a past event. Self insurance. This has never been tested, but a very good case scenario I mentioned to you in the class also. Can we create for self insurance? Can we create a provision for self insurance? No. What will you say? You will say, ki, sir, instead of paying insurance company, I know that if accident is not there, I'll not get the money. Instead, what will I do? Every year, I'll keep a small amount aside, saying I create a provision. In future, this will happen. It is an expense for me. You can't do that. It will lead to manipulation. So, repair and maintenance cost. Can you record a provision? No. Can you record a provision for any item which will purchase in future? No. You can avoid that. If you can avoid, no need to record it, sir. Yes, sir. Then decommissioning and other environmental cost. Any doubts in this? Dismantling cost, record it. Yes, sir. And then what do we do? And then what do we do? We recognize as an expense and then unwinding on this and we recognize into P&L. So debit expense or debit asset, and then each and every year we'll do the unwinding. Yes. Then coming to the disclosure, what are the disclosures, sir? Disclosures are what? Sir, we say is what is the increase in the provision, what is the expense in the current year, any reversal is there, any provision that has been paid, all these are what, sir? These points. Then for contingent liabilities, what are the disclosures? Sir, if it is removed, we will not provide any disclosure. And the description of the nature and contingencies. And if possible, to calculate the financial effect, calculate it and show it. Yes, sir. Then contingent asset, same thing. It is probable we disclose. What are the disclosure? The nature of the contingency. In case of contingent liability and contingent asset, we have discussed that, sir. Brief description should be given of the nature of the contingency, and we have to mention what the any financial effect. If it is possible to calculate the financial effects, we have to calculate it and disclose it. Simple. So with this, your IAS 37 revision is also done. You should remember what, yes, sir, to identify whether it's a provision or not, whether it's a contingent liability or not. So with this part is also done. Now coming to your IAS 38, intangible assets. Let us do the revision of this also. Now, intangible assets. What is an intangible asset? An intangible asset is an identifiable non-monetary asset without physical substance. So without physical substance means it's not tangible. Then it is non-monetary. Non-monetary means what? Not realizable in fixed or determinable amount. Then the control should be the power to obtain substantial economic benefit and ability to restrict others to take the benefit. When we will say it is identifiable, identifiable means what? When it is capable of being separated, it can be sold, it can be given on rent, license, etc. Or it arises from a legal conduct and have future economic benefit. If all the five conditions are being met, we recognize this as an intangible asset. If not, it will directly be recorded into P&L as an expense under operating category. Yes, sir. The example which you have seen, market share, marketing and advertisement, staff training costs, all are what? Not intangible asset, because market share is not identifiable. Advertisement and marketing will not no certainty about the future economic benefit. It's not probable. Then staff training cost, no control is there. Then I mentioned for combined asset, whenever there are combined assets where intangible and tangible assets are combined. If intangible asset is significant, then record the whole asset as per IAS 38. If tangible asset is significant, recognize the whole asset as per IAS 16. Sir, if tangible and intangible both are significant and we can separate it, then record as per IAS 16, as per IAS 38, separate. No issues in that. Yes, sir. So the first question that comes is usually what? Regarding the definition and recognition part. You have to define intangible asset, apply recognition, and decide if cost will be capitalized or not. Yes, sir. And identifiable is very important. Control and this and measurement. We have done the first question, then second one, and then training cost, then recognition principle. When will you recognize? When it meets the definition, future economic benefits and cost can be measured reliably. We have already included in the 5 points which we have discussed about. Then measurement principle. Sir, initially at what value we will recognize? Sir, initially we recognize at cost, whatever is the amount which we have paid to purchase the asset. So then subsequent measurement, subsequent it is recorded cost or revaluation model, cost minus accumulated amortization, accumulated impairment loss, and fair value method. Fair value revaluation model same as your IAS 16. Yes, sir. You need not know in detail, you should know the definition, revaluation model, the recognition is very important. So goodwill, can we recognize internally generated goodwill? No better, because it is not identifiable. So purchase goodwill, can we recognize purchase goodwill? No better. Internally generated goodwill cannot be recognized. Purchase goodwill can be recognized, because why we can recognize? Because it is identifiable, it arises from a separate contract. Yes, sir. Then internally generated intangible asset, self generated intangible asset, do we recognize? No. Why? Because the cost cannot be measured reliably. Then coming to research and development, sir. For research, what we do, research we recognize this as an expense in penal. Sir, development we capitalize when the conditions are being fulfilled. That is pirate. Probable future economic benefit, intention to complete, resource should be available, ability to sell, it is technically feasible, and then expenditure can be measured reliably. Then what cost of internally generated asset to be capitalized starts from the date when capitalization development phase begins, when all the criteria are being met. Then, if it is difficult to determine whether it's research or development, everything will be dumped into PNL only. Yes, sir. Then subsequent measurement we have seen. Now, when we can follow revaluation. So revaluation model can be followed when there is a active market. Active market means IFRS 13. Active market means where the volume is more. But when coming to IAS 38, IAS 38 says what? We restrict what? We restrict the revaluation, we restrict the fair value model or revaluation model for patents, brand names, trademarks, publishing title, customer list, and master. We here revaluation cannot be followed because there is no such active market. Simple. Then, sir, amortization. When will we start amortization? Amortization will start when, sir? Amortization will start when the asset is available for use, and it will be depreciated over what, sir? It will be amortized over the useful life. Yes, sir. Sir, will there be any residual value? So what is the maximum amortization? Cost minus residual value. So residual value will be normally zero. If any commitment is there, you should include it, or any active market. No such, it's not so important here. For FR it is important, but here, sir, amortization, the preference should be given to what? So the first preference should be given for the ratio of the expected benefit. As you get the benefit, record what? Record what? Record amortization on that basis. Yes, sir. It is recognized in penal under operating category as an expense. So useful life is finite. What we say, we amortize it. If it is infinite, then we will not amortize it. But annual impairment test is compulsory. So what are the three assets where annual impairment test is compulsory? Goodwill, intangible asset with indefinite useful life, intangible asset under development phase. Yes, sir. Then sometimes when the contractual period, I have done a contract with you for a license for 10 years, but I know this will provide a benefit for 6 years only. So I should amortize this for 6 years only. Bit. Then derecognition, when we derecognize an intangible asset, we have a gain or loss. That gain or loss will go in operating category. How do we calculate this? So net proceeds minus carrying amount we record. Yes, sir. So with this, your intangible asset part is also done. So see, the useful life and impairment is very important. Better. What does indefinite useful life means? There is no forcible limit to the period over which the asset expected to generate benefits. There is no such limit. Yes or no? It's difficult for us to calculate it. So that is the reason we say we should do impairment on this. So with this is also done. IAS 38 done. Yes. IAS 38 done. Then IAS 20. IAS 20 and IAS 23. Let us revise. Chalo. Yes, sir. IAS 20 government grant, accounting for government grant and disclosure for government assistance. Not important as I mentioned, but I mentioned for December attempt. Last attempt we have seen IAS 16, IAS 38, then your IAS 23. So this attempt IAS 20, 23, IAS 40. Be good with that. You should have a knowledge. Yes, sir. Accounting for government grants and disclosure of government assistance. Sir, government grant accounting will be done as well as disclosure. Government assistance only accounting is done. Accounting is not done, only disclosure is done. Yes, sir. Now, what did I mention? The example of government grant. If today the government is giving you a grant, will you record this grant as an income full today only? No, bete. You will not recognize this grant as an income in full today because of matching principle. Today you purchase an asset for 10,000 and the grant is for 2,000, and the asset useful life is 5 years. Government conditions also that you should use this for 5 years. So there are two methods to recognize this government grant. Either we reduce from the cost of the asset. I purchase the asset, debit asset, credit cash. Then what I say, so grant is coming in and we reduce the value of the asset. So my value of the asset is 8,000 and I normally depreciate it. So every year I record in P&L as an expense, and in my balance sheet I record non-current asset. Simple. This method is what? Reduction from the cost of the asset. Then, sir, deferred income. In deferred income, what we see? Sir, in deferred income, we purchase the asset. Instead of recognizing this as an asset, we recognize this as a liability. Why? Because if the conditions are not being fulfilled, we have to repay back. So debit cash, credit deferred income. So this deferred income is liability. So this 2000 every year we will take into penal over the condition or based on the depreciation ratio. See that 10,000 divided by 5, 2000 is the depreciation and 2000 divided by 5 is 4 as an income in the operating category. So every year I record depreciation income, depreciation income. So I get net is what? 1600 only, but the presentation way is different. It's a accounting policy here. Then non-current asset I record, sir. So then this government grant, which is that 2000 minus 4000 is what, sir? Remaining life is what? 2000 minus 4000 is 1600. This 1600 should be separated in non-current liability and current liability. So non-current will be how much, sir? 1200. Current will be the amount that is taken into penal for the next year. Every year we take penal and then this will reduce as per that ratio. Yes, sir. So these are the two methods which you have discussed. Then I mentioned government can provide grant either in cash or either in kind, sir. So scope, your this one IAS 20 will not be applicable to government grant which is covered in IAS 40. Government participation in the ownership of the entity. If government has a ownership in my business, no. Any tax benefit they have given, that also government grant will not apply. Government means what, sir? Local, national, international, etc. Government grant can be either in the form of cash or kind, and it is provided in the form of transfer of economic resource. Government assistance means what? Action by the government to provide an economic benefit specific to an entity or a range of entity, like free technical advice, free marketing advice, providing guarantees, etc. for the loan. Then government assistance, do we recognize this? No, we will only disclose it because it is difficult to measure it. What is the benefit out of that? Grant can be provided for two reasons: assets and income. Asset means what? Grant is provided because you purchase or you construct any long term asset. For income, what we say, it is provided to meet the obligations of the company, like some expenses which we are doing, for that they are providing as a income. Recognition, when will you recognize government grant? So recognize government grant should be recognized only if there is reasonable assurance that the entity will comply with the conditions attached to them and the grant will be received. What? When entity will comply with the condition and grant will be received. Simple. Then grant related to asset. There are two types of grant: monetary grant and non-monetary grant. First, we will cover what about monetary government grant. See now, in monetary government grant, what we say, government grant is receivable in cash. Sir, if it is received in cash or it is receivable in cash, two methods: direct from the cost which we have seen, or deferred income. Sir, in deferred income, if it is depreciable asset, what we do, we record this based on the depreciation ratio. We record this based on what? Depreciation ratio. Yes. Then coming to the next part. Uh, Conditional, unconditional, sir. So conditional, whatever is the condition, yes or no? The condition is that you have to use this land for 5 years, then take it for 5 years. Then the next part, unconditional. Unconditional, what will I say? I will directly take into penal as an income because there is no such condition attached to it. Simple. This is done. Then deferred income. Sir, in deferred income, we record current liability, non-current liability. Current liability is what? Expected amount to be amortized within next 12 months. Non-current liability is what? Total liability minus the current liability part. Then non-monetary grant. If the government is not giving in cash, they are giving in kind, they are giving any asset. In that case, we follow the fair value approach. Recognize the asset which you have received as fair value. Debit asset, credit deferred in grant, and this deferred grant record into penal over the condition. Whatever is the condition, whether depreciation or any other thing. Nominal amount. Nominal amount means if fair value is not available, then recorded 1, 2, 3 rupees, etc. This is done. Then grant relate to income, sir. Grant relate to income means what? We have employed 5 employees. Government is saying 70% salary we will pay you. So 30% is our expense, and that 70% is our income. So we say debit bank or grant receivable, credit grant income. If it's unconditional, directly we record into P&L. If it is conditional, same like your deferred one. Same like your deferred one. What we will do? Sir, record as deferred income liability and over the period we will recognize this into PN. Yes, sir. Then repayment of government grant. Beta. Whenever repayment is there, repayment means you have to pay back. If it is unconditional grant, you have recorded this into PNL as what, sir? We have recognized this as debit bank, credit PNL. We have recognized income. But once we say we have to repay back, what we will say? We will record an expense, we will reverse this, and cash is going out. Simple. The second method is what? Sir, we have recognized this as a deferred income. So the for the first 2 years you have recognized this, and after 2 years the government is saying what? The government is saying, yeah, pay back the amount. You have to pay back the amount. If you have to pay back the amount, see what is the amount. The government is saying what? Pay back the full 2000. So cash is going of 2000, and so deferred income liability was recorded because we have not taken the full 2000 into P&L as an income. I remove it and debit into P&L as an expense. Yes, sir. Case 3, what is case 3? Case 3 is from the reduction of the asset. Case 3 is what? From the reduction of the asset. So in case 3, what we say, sir, we have reduced from the cost of the asset. I have reduced and I have recorded this. So in after 2 years, the government is saying pay back the amount. In that case, I say cash is going out. Then what I say, I have to recalculate the value of the asset. Recalculate the value of the asset if grant was not received. If grant was not received, what will be my value of the asset? See now, calculate the value of the asset if grant was not received. That is 10,000 divided by 5. 2,000 is equal to carrying amount kitna hai? 6,000, sir. So 2,000 into 2, that is 4,000. Simple. So 4,000 is the depreciation. My carrying amount is 6,000. But here carrying amount we have recorded 4,800. From 4,800 to 6,000, increase it. 2,200, the value of the asset is increased. The remaining will be bought in penal as an expense. This is what excess depreciation which we have not recognized in previous year. Current year we recognize. So with this the repayment part is done, and then the government, you had a loan, the government is saying that you need not pay the amount back. So in that case it is an income for you. So what you will say, you will remove the liability, you record in penal as an income when you meet the terms and conditions of the whatever the government is saying. Yes, sir. Then if the government has given a loan at a lower rate, if the market rate is 9 but the government has given a loan for you at 6%, that 3% is what's a government grant. So you recognize debit grant, the credit loan, and the difference of the 3% is recognized as deferred grant, and this is recorded into penal over the period. So this we follow IFRS 9 accounting. IFRS 9. See, I had mentioned that the government has given a loan for 4% of 10,000. What do we do? What do we do? Sir, we have to discount this value. We have to calculate the contractual cash flow. Every year we are getting 400. This 400 I will discount at the market rate 8%. I get 867. So this difference is what? 1326. This 1326 is what, sir? Government grant. And this is a loan. I have to follow the normal loan accounting on this. Yes, sir. As per IFRS 9. So with this, your IAS 20 government grant is also done. Any doubts to anyone in government grant? I hope it's my hope my pace is okay. It's not too fast because it's a basic, yeah. Excuse me. Any doubts to anyone? No, okay then. No, okay, okay. Now, what is the last topic? IES 23. In IES 23, what will happen, beta? See, IES 23, borrowing cost. When coming to borrowing means what? Loan taken. Cost means what? Interest. So, cost involved in the borrowing of the funds. Yes, sir. So see here now, sir, effective interest rate we have seen it includes these all components. So this also forms, yes, sir. So normally what do we do, sir? Whenever we take a loan, we record this 10,000 as an expense in penal financing category. But the standard is saying what you can do. You can record debit, asset, credit, cash. You can recognize this as an asset. You can recognize debit, asset, credit, cash. And this once you recognize this asset, sir, this should be expense, no, sir. Yes, you will recognize this expense over the useful life. So instead of recognizing into P&L today one shot, we recognize this as an asset, and over the period we recognize this as an expense. So borrowing cost means what? We have discussed all these points. So see here now. If loan is taken, if purchase a building for business purpose, and if loan is taken and we purchase a building today and from tomorrow only we can use, will you capitalize here? No, Baba. Here I construct the building and the construction is taking 1 year. We capitalize here. So that means whenever there is an asset, that asset should take a substantial period of time to be completed. So see recognition, borrowing costs that are directly attributable to the acquisition, construction, or production of qualifying asset. Then we capitalize, otherwise expense to P&L. Which category? Financing, sir. Qualifying asset means what? Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intent use or sale. It is taking a substantial period of time. Sir, is substantial period defined here? No, beta. नहीं defined नहीं है. It is based on the judgment, but usually we consider it to be 12 months. Yes, sir. So see here now, everyone. When should we start capitalization? I say I have taken a loan here, but I've started the construction on this date. On what date I will start the capital? I will start from this date. From this date, later of 3 dates. Later of 3 dates, we will start the commencement. That is what, sir. Expenditure on the asset is being incurred. Borrowing is being incurred. Activities necessary to prepare the asset for intent use or sale have started. So later of these 3 dates, I will consider it. Yes, sir. Then I say my asset was completed here till this date. Then will I capitalize for this 1 month? No. I'll stop my capitalization here. So when will I cease the capitalization? I will stop the capitalization once the asset is available for use or ready for use. So do we consider minor modification? No, better. Minor modifications are ignored. Simple. Sir, in between for 2 months we have not done any construction. Do we stop here? Do we stop the capitalization? Yes, better. Construction was not done. If it is because of labor strike, we will stop it. If labor strike was done, if there was no labor strike but some other work was going on which was required for the construction of this building, then we consider it. So if it is a normal activity, no need, no reason. If it is abnormal, do we consider it? No, better. Simple. So see, capitalization should be suspended during extended period in which development is interrupted. In that case, we will not do the calculation here, we will ignore it. But if I say capitalization will not be suspended when the construction was not completed because the activity which is done is required here, like your watering, any technical work is going on, etc. XYZ. In that case, then two types of borrowing. What is the first type? Specific borrowing, general borrowing. So specific borrowing का meaning क्या है? Specifically taken for a purpose, for the construction of any asset, building, etc. General borrowing means for other than specific borrowing. Other than specific borrowing. So now coming to specific borrowing, the calculation for specific borrowing is what? Now, when I start my construction from this date, I will capitalize from the later of the date. So I've taken 100,000 loan at 10 percentage. So 10,000, I get the value. For how many months the construction is done, beta? So 10 months, sir. So what is the amount I will capitalize? 8,333. Sir, if this month it is going to P&L, this also will go to P&L. Yes, sir. Yes, sir. P&L, P&L, sir. Now, what I say here, I say the company is saying that the 5,000 out of that 100,000 they are using 50,000 here, 50,000 here. In specific borrowing, do we consider the date when the amount is used? No, bete, no. Specific borrowing, no. In general borrowing, we consider. See now, 100,000 into 10 percentage, 10,000 into 10 months only I will take, bete. 8,333 we capitalize. But now I say what? How much is the amount that will go to P&L? What is the amount? So 10,000 into 2 divided by 12, 1,667 will go to P&L. But now I say that I had this 50,000. So what did I do? I invested this amount. I invested this amount. I say I invested this amount. I invested this amount. I invested this amount and I invested this amount. This you will not do. Now, in case of specific borrowing, the date when the funds are ignored, we will not consider. Now, see here, everyone. Same example. I say that during this period, the amount which I had, I invested it. I got a return of 2,500 better. If I invested it and I got a 2,500 return, what will I do? Sir, whatever is the amount which you are capitalized, from that we will reduce what? From that we will reduce the interest element. So we'll get the net amount to be capitalized. So what is the sir? If this is going to P&L, if here we have some income, sir, that also will go to P&L, but income will not be there because fund is only not there. But here we had the fund, sir. In that case, income also will go to P&L, interest also will go to P&L. Simple. So specific borrowing formula क्या है? So what is the formula for specific borrowing? Actual borrowing cost incurred on specific borrowing less any income on temporary investment of specific borrowing. Actual borrowing cost incurred on specific borrowing less any income on temporary investment of specific borrowing. So here we do not consider the date. Yes, sir. Then coming to general borrowing bit. General borrowing says what? General borrowing says one important thing that we have taken a lot of loan. We have taken loan from SBI, HDFC, etc. A lot of banks. So now, when we utilize the funds, do we know from which amount we are utilizing? If it is recorded in separate accounts, you know it. But instead, what we will do here, we will do the in that case, what we say, one important thing here, we calculate the average rate here. What we calculate? Average rate here. We will calculate the what? Average rate here. Sir, average rate, how do we calculate? See, 50,000 into 10 percentage, 20,000 into 8, 50,000 into 12, and thus we do this calculation, the total interest by the total loan amount. We do this, we get 10.2, sir. Now, I say that we invest the fund on this date and on this date. Here, the date when the funds are used, we have to consider. In general borrowings, we consider the date when the fund is invested. Yes, sir. So 50,000 to 9 by 12 into the capitalization rate. Yes, 50,000 into 5 divided by 12 into 10.2. So the amount that will go to your the amount that will be capitalized is what? The amount that will be capitalized is 5,950. Sir, and the remaining thing, the remaining interest will go to P&L. Simple. Sir, will investment income be reduced here? Investment income, will we reduce investment income here? No, bete. We will not reduce the investment income. Simple. We will not reduce the investment income. So with this part is also done. Yes, sir. So see now capitalization. So here the date only expenditure incurred we have to consider. Then some important points here. Always first we use what, sir? Specific borrowing we use first. Borrowing cost cannot exceed the borrowing cost which we capitalize cannot exceed your actual borrowing cost. Whatever is your actual cost. Sir, in case of inventory, two conditions should be satisfied. It should not be on a regular basis. It should take substantial period of time. Yes, sir. And whenever the qualifying asset is at fair value, do we consider IAS 23? No, it is ignored, like biological assets. Sir, if preference dividend is capitalized as a liability, preference dividend is classified as a liability. This dividend will be what? Finance cost. Will this finance cost be considered as a borrowing cost? Yes or no? Everyone say me. I say preference dividend is paid on preference shares, and these preference shares are capitalized as liability. In not capitalized, we say are recorded as a liability. In that case, is the dividend classified as finance cost? Yes or no? Preference shares are capitalized as your liability, and you pay preference dividend on this. These preference dividends are finance cost. Is that finance cost considered as a borrowing cost?
No, sir.
No, it is considered bit. Preference dividend is a liability. On that liability, if you paid this one, remember your financial liability, your IFRS 9. if preference dividend is based on a preference shares and that preference shares are classified as what liability, then it will be finance cost on the same. But if borrowing cost will not include notional cost of capital, borrowing cost will never include notional cost of capital. Like my equity shareholders are there, they are saying we need a equity return. That equity return will not be a cost of capital here. So with this, your IAS 23 is also done. So we have discussed all the small standards possible. IAS 24, IAS 16 and IAS 40 pending. You can do it by yourself. So with this, each and every standard we have discussed. So chalo then. With this, any doubts to anyone? No doubts. Okay. So with this, can we end the session? So with this, your marathon is done. Yeah, 3 to 4 topics are there. Your ethics, you can do sustainability, revise it once. IFRS S1, S2, and then IAS 16, IAS 40, IAS 8, IAS 10. Once have a reading, it's enough. So with that, all the best for your exam. Do not panic. As mentioned, questions will be easy. So be calm. If you're calm, you'll get your answers. This should be free. If not, problem hoga. So with this, let me end the session. Bye bye. Have a good day. Signing off. Radhe Radhe to everyone. And all the best for your exam. Once done with your exam, please update me whether it was good, bad, difficult, easy, moderate, etc. Okay then.